Well, hello there. This is Robert Wolf with Terra Firma Business and Financial Consultants, asset coach and tax strategist. Welcome to another video podcast. And as you're well aware, what I'm trying to do here with these podcasts is just disseminate information. I know as a business owner, you're always looking to try to find information. And one of the things that we're trying to do here is give you the information as it is. There's no editing. The videos and the podcast interviews are all raw. So if you hear a dog in the background barking or a fire truck, well, that's just what's happening. So we want to be able to give you the information that you're looking for. I want to be able to also give you the various professionals that I work with as an asset coach and a tax strategist to be able to help you in a safe environment where you're not feeling like you're being sold something or you're trying, someone's trying to take advantage of whatever they're trying to do. And I don't want to be cynical, but remember, I'm a consumer as well. And so remember, as an asset coach and a tax strategist, the whole goal of my business is to look at your assets, to help you organize your assets according to how the IRS guidelines work and allow your assets to work more efficiently from a tax perspective so they can compound and grow more efficiently. Then at the same time, as a business owner, there's a lot of tax strategies that are available to you that we start looking at the business and looking at various tax strategies that are niche parts of the IRS code where your current tax professionals may or may not be well aware of. Well, that's where we come in. As we start reducing some of your taxes, what we do is, as a business owner, when we have saved money, what do? We put it back into our business. And so that's what we want to be able to provide to you. And if you choose not to put it back in your business and you want to put it in something else where it allows you to grow wealth, then that's fine too. So the bottom line is it's always your money, and our job as consultants is to show you how to find that money that's available to you. So without further ado, I have my guest today I'm pretty excited about. It's an area that there's not a lot of people who are aware of this particular field. It's becoming more and more well known as we have our generation and our population getting older. And actually, this area is being viewed as a pretty significant asset class within the finance world, and we'll get to that during the interview. But I wanted to introduce my guest today, Lisa, and I'm going to let her introduce and kind of give you a little bio and background of herself. But Lisa is in what we call the life settlement arena, and I'll have her describe a little bit more about what that is as we continue this conversation. So, Lisa, welcome.
Well, thank you. Appreciate it.
Sure, you're welcome. You're welcome. So, Lisa, give us a little brief bio introduction to the viewers, and tell us what you want them to know.
Well, I've been in the insurance business for 30 years, and I absolutely love insurance. So I call myself an insurance geek. And I decided to take a different approach, if you will. I've been in corporate for a very long time, working with a lot of agents and brokers. And about 3 years ago, I decided to stop being in corporate. It's time for me to stop traveling for all the right reasons, and decided to open my own business. But what did I want to do, right? And I found life insurance settlements, fell in love with them because I think it is such a needed service. I'm so passionate about them because it can be a really good solution for clients. And I do a lot of public speaking just to raise visibility, and you alluded to it earlier. Very, very, very few people, including financial professionals, know that there are options for life insurance policies. There's an option to sell a life insurance policy when it's no longer wanted or needed. And there's my passion. There's 500,000 seniors a year who will lapse their life insurance policies, and they just walk away from them, right? They just basically throw them in the trash. They don't know that a life settlement is an option, it's available, and is a solution for them. So that drives me. That's my passion. I love taking care of clients, love working with financial professionals like you, and I'm very privileged to be here, very honored, and thank you for having me as a guest today.
Sure, absolutely. So a couple things that you had mentioned that I just want to make sure that our viewers understand and clarified. And during all my interviews, I always, we get used to talking to each other, and so a lot of times we end up using insurance or industry lingo. And so because we're going to use this for information and educational purposes only, there's a couple things that I want to clarify. The first thing is the word lapse. The word lapse in the insurance industry basically says that if somebody has in a life insurance policy, and that's what we're talking about, a life insurance policy, and there are no longer premiums being paid, or there's some kind of financial obligation that you as the insured, the person who's actually writing the checks, stops doing. And there's no more money paying for the life insurance policy. It lapses. It doesn't terminate, it lapses. And that's the terminology that we're using. Wording is very important in our industry, so I want to make sure that's very understood and very clear as well. The other thing that I find fascinating, Lisa, about what you do is it's proof. What I keep telling my clients and people in the various conversations that I have, whether it's my videos or my public speaking or one-on-one conversations, is it is proof that life insurance, permanent cash value life insurance, is an asset class. It's proof. And I have this argument. You hear all these financial professionals, whether it's and I'm not picking on anybody specifically, but I'm just going to use some popular names that a lot of people know. We can use a Dave Ramsey as an example, or even there's a emergency physician by the name of, he's a white coat investor is the name of his company, and they're vehemently against life insurance policies based on what we're talking about. And the reason why they are is I think a lot of it is just misinformation. They don't realize it's an actual asset class. And so the reality is that who proves that it's an asset class is the IRS, for one. There's tax codes specific to the cash and how the cash is handled, whether it can be taxable or non-taxable. The other part is when we look at various parts of our industry, whether it's estate planning, tax planning, permanent life insurance, cash value life insurance is used significantly. Proof of why life settlement exists, because we have people in the older generation who may no longer need these policies for what they were originally put in place for.
Yeah, and to add on to what you were just saying, a life insurance settlement has been, and people are surprised, has been legal in the United States since 1911. So people are shocked about that. And back to your point about it being an asset, there was a Supreme Court decision, and the backstory on this is fascinating, but I know we don't have time to dive into it. It's called Grigsby versus Russell. And it went to Supreme Court, and Justice Oliver Wendell Holmes, in his decision, stated that a life insurance policy is an asset that I own, that you own, that whoever has a life insurance policy, they own that asset, and they have the right to transfer that asset to whoever they want at any point in time. So, yes, the Supreme Court made that decision in 1911.
Well, thank you for that, because, here's the other thing about it is that I like to try to keep things simple. And so I like Robert Kiyosaki, and I reference him quite a bit in my various conversations in my education. And one of the definitions he has for an asset is an asset is something that creates income. Plain and simple, it creates income. The opposite is a liability, which takes money. And so how does a life insurance create income? Well, it depends on really the design of the policy and how that is associated. So sometimes we design it to where there's a significant amount of cash and maybe lower amount of death benefit. And that we can use that extra cash as a supplemental income stream or a supplemental, savings account, if you will. But at the other side of it is that it could be designed for death benefit, and this is where life settlement comes into place. And really, let me talk about let me bring up what or why life insurance policies are no longer needed. And then what I'd like you to do is expand on that and go into a little more detail about how this process works, if you will. So we're talking to business owners, and any of the business owners that are watching this, let's say maybe you have a partner. Let's say just one partner, there's the two of you, okay? And there's an agreement that's put in place by an attorney called a buy-sell agreement. And this buy-sell agreement is basically an agreement that says that if let's say Lisa and I are partners of a business and I pass away, and well, guess what? My heirs, my spouse is now Lisa's business partner. Well, what if my spouse has no clue about what we do? And does Lisa really want my wife, who they may love each other like sisters, but it doesn't mean that my wife knows how to run a business based on what we do. And so what the buy-sell agreement basically says is that the surviving owner or partner gets to buy out the one that has just deceased. Well, who are they buying out? The spouse or the surviving heirs. Well, there's different ways of funding that buy-sell agreement in this example. Now, you can put money aside into a bank account, and we can go all the way down the list of the different funding vehicles, but the most efficient and the way that we use most of the time is life insurance. Because we can get to that dollar amount with the death benefit, it's simpler, and it costs less money based on the premiums paying for that death benefit. And so it allows business owners to improve their cash flow, and depending on how it's designed, it could still be an asset on the balance sheet for the business, so it doesn't affect their credit worthiness to be able to lease or manage equipment and that sort of stuff. The other thing is that, let's say it's not a buy-sell agreement. Let's say it's just I have a salesperson or a warehouse manager or somebody who is what we would consider an extremely important person in our business. We call them a key person. This key person is if they went to the competition or even if they passed away, what kind of financial effect would it have on my business? It would be very negative. And so we use life insurance again to be able to supplement not just the business to be able to try to figure out how to replace that individual, but also a lot of times we design it to where we care for the surviving family and heirs spouse, so they're taken care of because they're losing income when they lose this loved one. We're losing a key person from a business perspective, but they're losing a very important person in their actual family dynamic. So these are just a couple examples. If you're curious about more, go ahead and reach out to me. I'd be happy to have conversations about that in more detail, give you some examples, that sort of stuff. But so these policies, now let's go back to this buy-sell agreement, and let's use that as our example, if that's okay, Lisa. And let's say we have our two partners. They've been in business 30 years, and now one of them retires, or maybe they both retire. They sell the business, right? And now they have these life insurance policies. What happens?
Well, that's the real thing, right? So that's one example why someone doesn't want or need it anymore. I have a client right now that I'm working with in exactly that situation. He has sold the business, doesn't need the policy anymore, and normally what happens, they will just drop the policy, what I call throwing it in the trash, because they just don't need it anymore. And once again, don't know that a life insurance settlement exists. So if I may be so bold, let's talk about what a life insurance settlement is, and
sure.
then we'll talk about why someone doesn't need it anymore. That was a key example right there. But a life insurance settlement simply is the ability to sell your life insurance policy for a lump sum of cash. This will go to an investor group. The investor group will become the new owner of the policy. They will pay the premium on the policy, and they will become the beneficiary on the policy when the client passes away. So client gets lump sum cash today. Investor group is going to get the death benefit when the client passes away, 10 years, 15 years, 5 years, whatever that happens to be. So in the investor's minds, the shorter someone's life expectancy, the more money they are willing to pay for that policy, because they will obviously get their return faster. So you asked about certain situations where people don't need their policy. Well, obviously there's $500,000 a year, right? Since that's how many seniors will lapse their policies. So it could be anything from, you're right, key person policies. It can be the buy-sell. It can be, I've retired, my house is paid off, the kids are out of the house, they're fine, right? They're all married now. It can be, I no longer need the income replacement. Once again, I've retired. I don't need the income replacement because I now have my 401ks or whatever coming in. It can be my spouse passed away 5 months ago. I have a client right now that's the situation. It's like, why do I need this life insurance policy anymore? It could be a situation where someone has been paying into a policy since the late 90s, early 2000s, and these universal life policies are quote-unquote blowing up. And to be more specific, what that means is when these policies were purchased, they were illustrated, meaning that there was a chart given as to how much premium was needed in these policies to cover for the life of the policy. And these types of policies have a savings component. You alluded to that earlier. But in the 90s, remember, what was our interest rate back then? These policies were illustrated. You're smart. You're smiling, right? These policies were illustrated at 6 and 7% interest, but the savings component would grow at 6 or 7%. Are we in that environment? No, we're not, and we haven't been in that environment for a long time. So in reality, these policy savings components are growing at 1%, maybe 2%, and the savings aren't growing fast enough to pay the premiums. And so the premiums are, the cash is starting to be depleted very, very rapidly, making these policies no longer affordable for a lot of people. So that's another example. It could be a term policy, because we can sell term policies. It could be a term policy that's coming up to the end of the term, or maybe it's just a situation where, look, I've had this for 15 years. Like you said before, the house is paid off. I just don't need this anymore. Why do I continue to pay the premium? So just some typical examples.
Yeah, no, I appreciate that. That's great. Thank you. And I guess to your point, back in the 90s when interest rates were higher, right? Or even there's some people back in the early 80s, right? Everyone remembers these interest rates being extremely high, and now we've been at historic lows for a fair amount of time. And that was also a time where these policies were fairly new. And so actuarially, they designed these policies based on the information that they had. And we history teaches us a lot. Well, hopefully history teaches us a lot. We could not learn from it. But within the insurance world tends to learn from history significantly, because when we don't in the industry and the insurance industry, it's extremely expensive. And as an industry, we are contractually obligated with our policyholders to fulfill a promise. And so let's use Dave Ramsey as an example. To his point, if he's talking about these policies are expensive and, these aren't going to work, well, he could be using experiences based on this type of situation that we just talked about. But the reality is that every industry goes through innovative periods where various things change, because it goes to the old adage, follow the money. Right? If you have less money as a business owner coming in, as a business owner, you got to figure out what you're going to do. You either got to innovate, create new product, reduce your prices, or invest in salespeople because you don't have enough people getting the word out. Whatever the dynamics is. So with regards to life settlement, this is really interesting because so what we're talking about is, let's say we have a married couple, and they're in their 80s, to your point, and a spouse just passed away. You alluded to a client that you're working with right now. And he could easily say, I'm just not going to spend the X amount of dollars anymore. But the reality is, because it is an asset, and again, back to my point earlier, is that as in the insurance industry, this is a contract. The insurance companies are obligated to pay a death claim if the client held up their end of the bargain and continued to pay the premiums. So if we have a client who cannot pay the premiums, or maybe just doesn't want to, but there's value to this asset, you have investors, BlackRock, Berkshire Hathaway being two of the largest purchasers, right? Investors. Correct. That will come in and influx those investor dollars to take over these payments. Why is this beneficial to that individual? Why is this beneficial to that policyholder?
Well, I think it's back to your point. They don't want the policy anymore. They don't need the policy anymore. And I keep using the terminology, throw it in the trash. I mean, they literally were just going to let it drop. And for many of my clients, it's a function of, why wouldn't I get something for it? I've paid into it all these years. Why not? It's a bonus, right? So for them, that's the situation. And I think I should clarify who we are and what we do. As life insurance settlements brokers, what we do is represent the client to garner the most value for their policy that we can. So we have access to about 30 different investor groups. You mentioned a couple of them. And I will tell you, 2 new funds this year came in at $900 million apiece. There's a lot of money coming into the industry, which is fantastic, because when you have supply, right, policies that are no longer wanted or needed, there needs to be demand. There needs to be somebody to buy them. And there's a lot of interest in purchasing these policies. So we, for lack of a better word, shop the policy out to many different investor groups, once again, to get the most value for the client, which is better, in my opinion, than people calling an investor group direct. There is one that's advertising right now. We actually work with them. They're buying one of our policies right now. But when you call the 800 number, no disrespect at all, they're very good, but they are trying to get the policy as inexpensively as possible. We drive up the value because we can leverage our relationships. So there's that. Now, the answer to your question is, why would an investor want to do this? For them, besides the fact the returns are better than having a money sitting in the CD, right? Right, clearly. But more importantly, it's a diversification tool for them, because if you have a life insurance policy in your portfolio, is it tied to the stock market? Is its return tied to the bond market? Is its return tied to anything going on in the world? It's not. So they use it as a diversification tool because it's not tied to anything.
Interesting. So I think we should stress the point that you made is that you work for the client, the policy holder, to try to extract the most value out of this asset as possible. So let's say somebody has a $5 million life insurance policy and it was a buy-sell policy and they were spending, $5,000 a year on this, because this is, say, assume 20 years old or whatever. I've done this for 20 years. That's a significant amount of money. So to your point, if you just throw it in the trash, then literally it was expensive. We just got rid of it and we just threw those monies into the trash. But enter you, Superwoman, comes in and starts saying, hey, you know what, you can actually recoup some of those dollars, if not all of them, or even maybe a little bit more depending on the situation. Let's run some calculations and illustrations and see what we can do by going out to these various investor groups. And why would we want to do that? Why would they want to do that? It's a business transaction. And I think that's a very important indicator here that you're bringing up here, is that this is in the investment world, it's a term we call correlation. And when something's correlated and we're making investments, so let's say, and we're not giving investment advice here, this is just educational. So any of the regulators out there that watch this, we're just talking here. But if I have 2 mutual funds and I look at the top 10 investments in the mutual funds, there could be a lot of overlap.
Right.
Now, yes, I have 2 separate mutual funds and I could be quote unquote diversified, but my allocation is basically the same. And so my dollars are really invested in the same top 10 where I could just need one. But to your point is that this life insurance policy has nothing to do with the stock market. It's non-correlated. It is completely diversified away from the market and creates some kind of safety for these investors. And that's the reality that these guys look for. Yes, they're looking for their best rate of return, but at the same time, they're smart enough to protect their assets as well. Just the same reason why we bought life insurance in the first place, to protect the asset, which is the human earner, and replacing that income as a human asset. And so I think that's very important that you bring that up. Now, talk about the process. So let's say I am I'm somebody who's in this situation where I have a policy and I was just talking to my let's say my daughter, let's say in my 80s, right? And maybe I don't have really good health. I have this policy and my daughter's saying, hey, you know what, Dad, you really need to get rid of this expense. You don't need this anymore. Mom's passed away. We as kids, we all are taken care of. We're all professionals and we can take care of ourselves. Dad, you really don't need this policy anymore. What talk to us about this process and how this is important for daughter to realize how this is actually beneficial to dad to go through your process.
Right. So I look at myself as a real estate agent for life insurance policies. So think about it along those lines, meaning that this is a 3 to 5 month process. Now, every once in a while, I will run into a client who is in a situation where they didn't know about this until it's just about too late. I literally got a call from a client yesterday. It was from a financial advisor, actually, whose client has a policy that's going to be up at the end of October. That is a really short time period and does not allow us to really do the work that I would prefer to do, but we're in a situation, right, where it's crisis mode pretty much, and anything we get for him he's going to be happy with. But still, point is 3 to 5 month process. Here's what it looks like. There's no upfront money to the client, so there's no application fees, there's no medical exams, there's no what we call paramedical exams, nothing. There's an application, and a lot of the application, I always tell clients when they see this, don't freak out. It's about 12 to 13 pages. There's a lot of legal disclosures, and rightly so, to talk to their tax professionals and their financial professionals, make sure that they're making the right decision. And it's information really about the policy. There's also disclosures in there with the HIPAA form, which allows us to go get medical records, so it's a release form. There's also a release form in there about us being allowed to go to the life insurance company and get an illustrations, those charts I was talking about earlier. We need updated charts, if you will, to give the investors an idea of what the premium is going to look like over time. So with that, I also asked for medical history, and here's the reason why. We need to go get medical records because the investors typically, they have their own formulas, but there are 3 primary components. They want to know what kind of premium they're going to have to pay. That's the reason we get the illustration. Number 2, how long are they going to have to pay it, i.e., what's the person's life expectancy? And then, of course, they look at the death benefit that they're going to receive at the end. So they do their own internal calculations. But in order to show them those documents, we need medical records. And they reverse underwrite, right? They look at the medical records and they determine what they think this person's life expectancy is. So I ask for medical history because what we don't want to have happen is have medical records sitting out there that we don't know about that can help us in marketing the policy. So application, health history, and we run with it from there. I always do like to get a copy of the policy ahead of time if I can. It's not mandatory, but that's good because at some point in time, the investor groups are going to want to see the language in the policy. They want to see what they're buying, right? So through that, we get the medical records, we get the illustrations. That takes somewhere around 30 to 60 days because sometimes doctors can be a little bit slower to respond. But at that point in time, once we get the medical records and the illustrations, we go to work and we go market. The investor groups need time as well to do their calculations, to review the medical records, to do their underwriting. So I like to set expectations properly that it's 60 to 90 days really before we hear back from investor groups. And at that point in time, the client can, if we don't get offers, because sometimes policies can't be sold, at least the client knows that when they drop the policy, that they're not leaving any money on the table. If we get offers, the client has a choice as well. Do they like the offer or not? And if they don't like the offer, and I have a client right now who said, yeah, not enough money, fine, walks away, no problem, no money out of pocket, just cost some time to fill out the application and the health history. If the client says yes, I like that, I want to move forward with that, it goes into escrow like a house because the escrow protects the client. So if something happens in that escrow period, it reverts back to a regular life insurance policy and the beneficiaries are paid. But in that escrow, what happens is that the paperwork is submitted to the insurance carrier to make the investor group the new owner, the new payer, and the new beneficiary. And then once that's completed, the client receives their lump sum, and there you go. But even 30 days after they sign the contract with the investor group, they can pull out as well. And sometimes it's even 15 days after they receive their money, they can pull out and say, you know what, I changed my mind, I don't want to do this. So there's a lot of consumer protections. It's very transparent. And I'm going to add a little bit more information in that the investor groups want to make sure that this person is making the right decision for them. So the beneficiaries need to sign off. That's really important. So everybody knows what's going on. There's no surprises. And in some cases, depending upon the investor group, they even want a doctor's statement that someone's of sound mind and body to be able to make this decision. And I think that's really important, a lot of consumer protections.
Yeah. Well, the one thing that just was blaring out at me during your explanation, which I really appreciate, is there's no emotional decision here. This is all business for both parties. Correct. There is so much due diligence. There is so much information that's being shared for both parties. To your point, the consumer protection aspect of it, and the policyholder can still back out if they want to, and they're in full control, as well as the beneficiary. So we don't have heirs that when dad dies, the heirs think that there was some kind of senior abuse going on, right, and taking advantage of dad or mom. And I think this is fantastic because, one of the things we try to do in my business and my practice working with business owners and my clients is try to take the emotions out of the planning process. When I first got into the insurance and financial world, and this probably was the same for you when you first got, we're trained a lot to create emotions in the conversation, build their dreams, build their goals, and start really addressing why they want to do these steps to start saving money for their future, and use their goals and dreams as leverage of why they do that. It's an emotional connection. And the reality is that it works, and that's why it's being trained. And sometimes we have to protect our clients from themselves, but I just never felt comfortable with that. For me, it always had to be a transaction that all parties understood number-wise. Why are we doing this? What is the nitty-gritty? And it's like painting a room or painting a house. There's a lot of prep work ahead of time, right? We got to fill in the holes. We got to fill in the cracks. Why do we have cracks? We got to tape up things. We got to do a lot of prep work ahead of time to make sure that things are done properly, that we all understand why we're doing what we're doing. So when it comes painting time, it's smooth. We're committed. It goes smooth, and things can be done accordingly. Now, here's the continue my painting analogy. Is that here's the worst part about finishing your painting. All looks good. You pull up all the tape. You put all the plates back on, the power plates, and all this kind of stuff, and put the hangers back up. And you're getting ready to start hanging up the pictures and all the fixtures and all the cosmetic stuff on the walls. But then you see that one smudge or that one gap in paint.
It'll make you crazy.
It makes you crazy, right? And you can bring your spouse or somebody else in and have them take a look at it, and they won't see it, but that's all you see. And yes, the moment you tell them that, look, I missed a spot, what's the only thing they're going to see? Is that spot.
That's right.
And I see this planning process, at least for me, the same way, is that there's got to be a lot of due diligence, because at the end of the day, Lisa, and you'll agree with me that none of this is our money.
No.
None of this is our money. We're the professionals that are trying to consult on what needs to be done with these hard-earned dollars. And that's the important aspect about this whole planning process, is that the numbers need to prove why we're going to do what we're going to do. If the numbers don't prove it, emotion can't prove it. Then something needs to be adjusted, whatever that is. And so I love what you're saying, because it really falls into how we do things on the front end. And what allows me to do also is I'm working with plans in your area, it allows me to think of the exit strategy. When you talk to very successful investors and business people, they always say you need to know your exit before you enter. And what's interesting, too, is when you talk to the military or certain special forces or the SWAT or first responders, one of the things they always say is when they enter a situation, they need to find their exits before they enter the situation. Why is that? Well, because stuff never works the way we want it to. And if it does, great. We still know where the exit is at, but we need to understand why we're entering something. And so that's what I love about your explanation, and what the process you're taking is instead of sitting across the table from the client, you're sitting arm in arm right next to the client,
right,
walking through this process together and figuring out, why do you want to do this? And I think that's fantastic.
Well, I appreciate that. And let me just say, I'm a big believer in life insurance. I think life insurance is really, really important. I have it. My husband has it. But back to your point, there comes a time sometimes when we don't need it anymore. What we bought the policy for 5, 10, 20, 30 years ago is no longer an issue. It's done. I don't need this anymore. So I also am very strong of the opinion, obviously, that someone should have the ability to sell that policy when they don't want it anymore. I just think it's really important that people know they have options. It's not the right option for everybody. It shouldn't be the right option for everybody. But they should, once again, talk to their financial professionals, and figure out if maybe there's a better option, like restructuring the policy, maybe reducing the face amount, whatever it happens to be. But I've got a client right now who's got $1 million term policy, and he's going to convert $250,000 of it and convert to a universal life policy. He's going to keep $250,000 of it, and he's going to sell the other $750,000. Why not? It's an asset that he owns. So there's so many different situations where this can come in handy in a person's life. I talked to a client literally about an hour ago, and it's a family situation where husband and wife are in their 80s, and the mom and dad did a really good job saving, They're both in assisted living right now. Mom needs memory care, and dad can't afford it, but it makes him crazy to see the bills going, the savings account going down every month. So they're looking for other ways to generate cash. And in this particular case, this is an example of where a life settlement does not make sense. They had some smaller life insurance policies, but it was a huge cash balance. So back to your point, we're talking about savings accounts. There's a massive cash balance in there. And I told the family, I said, you know what, that's going to be your better option to access that cash versus selling the policy. So there's so many different situations where people, once again, want to use their policy to help themselves, and they should be able to do that. But a settlement does not make sense for everybody. And I talk to a lot of financial professionals and clients every day. We really talk about what do you want to do with this? Why are you selling the policy to make sure it's the right decision for them?
Mm-hmm. I think that's great. And, it's interesting you brought up the example there where the family had a lot of cash already in the policy. Mm-hmm. And, it's funny is I see that a lot where people who have these types of policies don't realize they actually have access to it.
That's what happens.
Right. And I think a lot of times it's because there's certain periods in time where there's turnover in industries. And the insurance business, the financial world, the financial business is a very difficult business to get into. There's a lot to know. There's a lot of regulations. There's a lot of things that you need to understand how to be the right fiduciary for your clients. And so there tends to be a lot of turnover. It's a very exciting, enticing industry to be in. And so there's the barrier to entry is very limited, or it's very small. So it's easy for people to get into, but it's easy for people to get out of as well. Right. And so my point is that there's a lot of policies that have been sold over the years, and I say sold, or we can say bought, whichever way you want to look at it, that people were just diligent. We needed this policy, and they've made the premiums. It was part of their budget line item. And, to your point, 20, 30 years later, all of a sudden they have this cash. They really didn't think there was going to be cash because that's not why they bought it in the very first place.
That's right. Well, and that's right. And this particular family, it's kind of interesting. As we were talking about, mom has a small policy, dad has 2 small policies. And I said, do you know what kind of policy this is, right? And because I was talking to one of the daughters, and we were on speaker, and Dad was in the background, and the daughter says, no, I really don't know. And Dad in the background, and I was telling her that there can be some savings components to some of these policies, so it's really important to find out what kind of policy is it term. At his age, I doubted it was, but you never know. Or, sometimes there's savings components, and if there's savings components, that could be a better way to access, the cash that you're looking for right now. And Dad in the background said, whole life. I said, bingo. Okay. I said, so here's what you need to do. Call the company and find out what your cash looks like. And Dad goes, I know one of my policies, he had like 80% cash in there to policy value, to face value. So at that particular time, right? And the other one, they didn't know. I said, call the care company and find out how much cash you have. What's the cash surrender value? Because that's going to give you a better option. In their situation, it's going to give them a better option than selling the policy.
Yeah. You bring up a good point, too, because, there's times where certain policies should be replaced because of the design and the features and how how it originally was engaged and purchased and sold, and people's things that their lifestyle changes and quite honestly the policies change too. They're less expensive now. The actuarial tables go out farther, and so there's less costs with them. But at the same time, it makes sense, and sometimes it doesn't make sense. And in this situation, I think it was very wise of you to let them know that, hey, you have cash. This goes back to your point: is you're sitting on the same side of the table as them, right? You're working as a advocate for the client, and that pays back in spades because I think it's refreshing. This doesn't happen or occur a lot in our industry or industries, if you will.
Well, it's the right thing to do, right? It's the right thing to do, and it's about taking care of clients. So the reality is that we're here to do what's right. We're here to take care of people, and that is what we love to do. But you're talking earlier about a client. Or about people who have life insurance policies that they're not as good as the policies today. I have a client right now who has a $4.7 million policy. It's a financial planner calling me, and she was saying that she needs to get this client out of this policy because it's really old. It's not the best fit for him anymore, and so she's in the process of getting him a new policy. So what do you do with the old one, right? So we are looking at selling that old policy.
Interesting. You brought up a scenario earlier too about somebody who had a term policy and he converted a portion of it and sold the other portion of it. And I think that's actually very smart planning because it's kind of the best of both worlds, if you will. And I thought that was interesting. It's a good way because I think sometimes people think, well, if I have $1 million policy, then I have $1 million, and then if I only need 250, so it's too expensive for me to go get a new $250,000 policy. But to your point is that that's not necessarily the case. You can restructure these policies, which is a really important part of the planning process.
Yeah, you can. So I have clients, it's a couple different things. I have a couple clients right now whose term policies are coming up, i.e. I just talked to a lady in Colorado yesterday, and her husband's term policy is up in January. They're, once again, retired. They don't really need it anymore, and they're certainly not going to get new insurance, and they don't need to convert it. They just don't need the coverage. So that can be a really good opportunity for people because, once again, they just don't need it. It's just going to drop. The other thing that people don't know about is there can be a way, this world is pretty creative, depends upon the client's situation, but there can be a way where we can retain a death benefit. So what I mean by that is if there is enough money that the investor group is offering, and I'll give you an example. I have a $1 million policy right now on a client, and she the offer on her policy is $365,000. And it's the heirs, actually, the beneficiaries, that want to sell the policy because it's just getting too expensive, the cash is about to run out, and they just don't want to make the premium payments, right? So they're coming in. But the point is if, let's just say, they wanted to retain a death benefit, there's a possibility of doing that. So what I mean by that is, let's just say they wanted to keep $100,000. Maybe what happens is, instead of getting $365,000 in cash for the policy, they will get $300,000. I'm just pulling numbers. They're going to get $300,000 for the policy and retain a $100,000 death benefit. So when mom passes, the beneficiaries could still get $100,000. That's possible if there's enough money offered from the investor group. So it's very, very creative what we can do to take care of clients.
Interesting. So let me ask you this. So is this something that is beneficial for, let's say, somebody in their 50s, and they're in a situation that they have a large death benefit or a life insurance policy that how could this work for somebody in their 50s, or does it?
Well, the answer is maybe, because I have a client right now who is in his 50s, is in his late 50s. He has significant health issues. So one would ask themselves at this point in time, why in the world would someone want to sell their life insurance policy when they have significant health issues, right? Well, the reason for him is he's saying, look, I don't know how much time I have left, 5 years, 10 years, not real sure, but I want to make my life as comfortable as I can while I'm here. So he's basically selling his house. He's selling his business. He has a dream of living out of state on a ranch, and that's what he wants to do. So he says, if I can get a good amount of money for my policy, I want to do that. And the heirs, the beneficiaries, are saying, you go, Dad. You do what you need to do to take care of yourself, while you're still here. So there's an example of someone in their 50s. But typically, if somebody's in their 50s and they're really healthy, this is probably not going to work for them, because the investor groups are looking for life expectancies of 10 years, maybe 15 years, and sometimes 20 years or less. And remember, the less of a life expectancy somebody has, the lower the life expectancy, the more money an investor group is willing to pay for that. That makes sense, right? They just receive the return sooner. So point is, if someone's in their 50s, it's possible, but it's not probable. It all depends upon health.
Yeah, that's interesting. Yeah, and it's people's situations are they're unique, but it's their situation. It's their life that they're
right.
living with. So let me ask you this. So this is something that I'm curious about, because when we're talking about somebody who is in their 50s or even in their 80s or 70s, and we're talking about the old universal life policies and so on and so forth. Talk to me about the newer policies. These newer policies that have these living benefits. And, and living benefits for the viewers basically means that there's certain criteria where you can have access to the death benefit sooner due to certain life events that allow you to trigger that. So, for example, one of them would be, let's say, like a chronic or critical illness type situation where maybe you're, critical illness where you a heart attack or stroke. And then you have access to a percentage of the death benefit ahead of time. Also, chronic in some situations is, if you become in a position to where it's you can't perform 2 of the 6 daily activity lifestyles, what we call ADLs, and some would call it long-term care. Some states don't like that being called long-term care because it could be confusing to the purchaser or the client. But basically, you're unable to do 2 of the normal daily activities that we all take for granted. You have access to a percentage of the death benefit. So Lisa, let me ask you that. It's about, I'm healthy. When I bought this policy, I liked the idea that I had these living benefits, if you will. And now all of a sudden, fast forward, 5 years, and now I'm 5 years here, and I'm not healthy anymore. I had a physical. My doctor said there's some situation, and what do you do in that situation?
Well, first of all, I just want to say that the living benefits are really important. I love the fact that the insurance companies are coming out and they have these new provisions in their policies, because what I feel bad about, or what I don't want to have happen, is somebody having to sell their policy when they have just a few years to live, right? That shouldn't be the situation where you have to sell your policy. So the ability to access, like you said, these living benefits, these critical illness benefits, I think is really important. And the hybrid policies that you're talking about, where people can access long-term care benefits, much more preferable to have those types of policies, and I'm really happy they're out there, because I think they're better for the clients. When they need them, they're there. Like I said, I have a client right now that a broker called me about, and this person has a term policy. It does not have any of those provisions because it was purchased a long time ago. He has, once again, significant health issues where we're talking about, 6 months to live, and those benefits are not available to him, and that really hurts me. It hurts me. But I will tell you what's really awesome about that, and this goes back to what I was saying earlier, he's got a $500,000 term policy. Selling it outright would net him about $380,000 on that $500,000 term because, once again, his health issues. And he's in his late 50s as well, by the way. Not the same client. But the neat thing about this situation is that I was able to work with an investor group who will give them some cash up front because they are cash strapped, basically. They're trying some experimental treatment. We'll give them some cash up front, but also retain a $250,000 death benefit. So they're talking about, giving them $205,000 up front, but retaining a $250,000 death benefit. And the longer he lives, that death benefit goes down just a little bit, almost like an interest payment on the $200,000. So, if the doctors have given him 6 months to live, so if he, lives the 6 months, they might get that $455 total. But if he lives longer than that, then the death benefit will go down. And I think that's, once again, a really creative solution that we can put together as a life insurance settlements broker to take care of the client and their unique needs. So that was a really long-winded answer to, I really do believe in those provisions in the policies, and I think they're really good because, once again, if someone is in that crisis situation, that is not the time where they should have to sell their life insurance policy.
Yeah, I think that's great. So I appreciate you sharing that because, and the reason why I brought up the living benefits and these hybrid policies is because I think the insurance industry, again, what I said earlier, follow the money, and there was a need, and they're trying to fulfill the need. In certain areas of the insurance industry, there's gaps, and people sometimes it's price prohibitive to buy some of these policies due to, and people like guarantees as well. And so the life insurance side of things saw a need, and they tried to fulfill that need. But what I like about what you're explaining is that even if somebody has these living benefits on a policy, the creativity that you're able to bring with the investors is whether they have these benefits or not, it could be more advantageous to a client to not take advantage of these benefits and actually go the life settlement route, or take advantage of these benefits and not go the life settlement route. But the key is the due diligence was done. The numbers were ran, the planning process was going through what it does and figures out what's the best situation for the client. And as a consumer like I am, finally, it's nice to feel that you have, as a consumer, the opportunity to actually have the right situation come about. The problem that you and I have, Lisa, is that there's just not enough people that know about this, advisors included, right?
That's right. Absolutely. Or if they do know about it, in all fairness, there's a lot of misperceptions. So I call it the 8 myths of life insurance settlements, but we addressed most of them here. That people think that, oh my gosh, I have to be seriously ill to sell my policy, and that is not true at all. I sold the policy of my friend, and she's healthy. She didn't get a lot for her policy, but she was thrilled. It was a term policy. It was coming up at the end. She wasn't going to convert it. She was just going to let it drop. So in her mind, we funded right before Christmas of last year. She's like, yay, Merry Christmas to me, right? So no, you don't have to be seriously ill. There are opportunities for, a lot of different people.
Yeah, no, I think that's fantastic. So I guess our big quest here is we got to get the word out, and
Right.
and I think what's been very valuable to me, Lisa, and why I like having these conversations with other professionals, and I think this is very important for the viewer to understand. Just because you have a life insurance policy, just because you have a life insurance agent, just because you have a CPA, just because you have a financial planner, doesn't mean that all the information is understood and is out there. You need to do your due diligence, but here's the problem. What questions do I ask if I don't know there are questions to ask?
Right.
And so that's why this video podcast is such a need, in my opinion, is that it's the opportunity to share. And being in my world and doing what I do, I come across a lot of amazing, extremely smart, caring people like yourself, Lisa, that the information has to be shared. What you do has to be shared. And it may not be any of my specific clients that I have right now, but that doesn't mean that the situations don't come up. And it may not be my client, but it may be their best friend that is going through the situation.
Or mom, or dad, or their uncle, or you just don't. It could be a coworker. I mean, you just
Correct.
don't know.
Correct. So viewers, you're probably sitting here going, well, what just happened this last hour? It goes by very quick. I got to tell you, doing these video podcasts go by so quick for me. And to your point, Lisa, being a insurance geek, I am as well. And I am a total geek when it comes to taxes, to real estate, to investing, to insurance, all of it. And that's why my business model exists and why my clients come to me. So if you're watching this and you have an interest, or you have questions, or you have a friend or a colleague or a family member that, hey, Bob, Lisa, I think this is a situation that may be beneficial, don't even think about it. Don't even try to figure out if it works. Just reach out to me. Reach out to me in this email, in this podcast. I'm going to give you the information verbally. You're also going to have my contact information based on how this podcast was delivered to you, whether it was delivered to you via email or LinkedIn or Facebook or whatever the case may be, or even a webinar type situation. But reach out to me. Let's have an initial conversation. Let's see how we can get Lisa involved in this type of situation and take advantage of. Take advantage is not really a really good word, but I think we're okay with this, Lisa, right? Take advantage of Lisa's expertise to help us understand, is this viable? Because as you can tell, if it's not, she's going to tell us. And that is what's fabulous about working with people like Lisa and the other people that I have the opportunity and the pleasure to work with. So, Lisa, I just want to say thank you so much. I'm going to give you the opportunity to, if there's any last few things you want to say, and use the last 5 minutes or so to help express that we didn't talk about, that you think is important for us to understand. I'm going to give you the microphone, and please share.
Well, thank you. I appreciate that. So one of the myths, we talked about the myths of life insurance settlements, right? And we addressed most of them. We talked about the fact that this has been legal in the United States since 1911, which blows people away. Just so people know, nothing really happens in this industry until the mid-1980s, and that was kind of the Wild West back then. They were called viaticals, and sometimes people remember that name. But the life insurance settlements industry, as people started living longer and the medical technology allowed us to live longer, the life insurance settlements industry really took effect and took place in mid-90s. What I do want people to know is this is a highly regulated industry. This is not the Wild West. This is not what it was in the 80s. So I have to have special licensing. The investor groups need to register with the Departments of Insurance across the United States. The policies that they purchase every year. So this is not your next door neighbor buying your policy. I just want people to know it's very, very regulated. There's a lot of disclosure language. So we talked earlier about how the application is really long. That's a lot of disclosure language that the NAIC, which is National Association of Insurance Commissioners, and NCOIL, National Congress of Insurance Legislators, mandates that the states put in there. So each state kind of takes the model language that they want to use. So point is that besides the fact that it's legal, it's very highly regulated with special licensing, and I just don't want people to think that, you know, like I said, the next door neighbor or your brother is going to buy your life insurance policy, because that's a biggie.
Yeah, that would be weird, going to uncle and doing that. So thank you, Lisa, for sharing that. And I think it's extremely important to know that the industry as a whole is highly regulated. A lot of people don't realize that. Though you can go online and get a quote or buy a life insurance policy, and just because the distribution or the purchasing process has been simplified with the internet, that doesn't change the fact of how regulated the industry is for both us as professionals, as well as for the insurance companies, as well as for you as a consumer. You know, there's certain things that we all have to abide by. There's something called insurance fraud. So we go through these due diligences as an industry through this overall process for the protection of everybody involved, because the reality is it is a contract. It's an obligation for all parties involved. So I'm glad you brought that up, Lisa, about the regulatory compliance, and it's extremely important for people to really realize that, and to realize that there's a lot of people in the media, write books, magazine articles and such, who are not licensed, who get to say whatever they want to say and do not get held accountable for what they say is their opinion because they are not licensed. That's a loophole in this whole marketing scheme of talking about finances in general. And so that's one of the things that's extremely important. They can say stuff that you and I cannot, and because you and I are held to a much higher standard.
Well, and that's true. And I think, you know, since I'm in this industry, what's interesting to me is just, you know, people think term policies are term policies are term policies. So back to your point, they're not. Not all term policies are built equally. So be sure, in any life insurance situation, be sure you understand what you're buying. And here's the reason why I'm saying this. So term policies, we know, can be sold, right? Typically, they have to be convertible into something more permanent, because an investor group isn't going to purchase anything that's going to end. Typically, not always, but most of the time that's the case. My point is that the conversion to a universal life or a whole life, which may be important for a client, by the way, in or out of life insurance settlement world, it matters, because in the conversion privilege, I've seen conversion language that says you can convert to age 65. I've seen 70. I've seen 75. I've seen 80. I've seen to the end of the term. That's all fine and well, but you need to understand what those conversion options are. The other thing I've seen, though, is I've seen, hey, you can convert this policy to age 70. I had a client who was 68, wanted to sell his policy, his term policy, convertible to age 70. That's fabulous, right? He's 68. However, when you read the second sentence of the conversion privilege section, it said, or 10 years on the policy. And he was on the policy for 14 years. We couldn't sell it. Not only could we not sell it, if he wanted to convert it, because he had a stroke, even if he wanted to convert it to get permanent life insurance, he couldn't do it. So back to your point, you know, all life insurance policies are not created equal, and it's really important to receive that feedback and that analysis from a financial professional.
Yeah, no, you're right. It's, you know, being in my business model as a consultant, we're pretty much agnostic to what product and carrier we use. But the products and carriers that we do use, we use them specifically for a purpose because of what you're talking about regarding the due diligence. I'll share a story with you. When I do offer term insurance, and term insurance is an extremely important tool in somebody's plan, from not just a cash flow perspective, but a risk perspective and coverage perspective. We all know that it's less expensive to purchase a higher amount of life insurance versus some of these other policies. But a lot of my clients have all three types of policies that are out there: whole life, index universal life as an example, and term insurance, because they each were designed specifically for what they are and what they mean for a client. But I had a situation, this is about 15 years ago, where all the term policies that I offer are convertible for the length of the term.
Beautiful.
And sometimes they tend to be a little bit more expensive. But let me share an example of what I mean by that. I had a situation, I was working with a physician. She was a pediatrician. And she was shopping around, and I gave her, I think it was like $1 million policy, maybe 10 or 20-year policy, probably 20. And she was shopping around, and I was literally, annual premium, I was $35 more annually. And I know what company she went with. And she didn't go with me because it was $35 more. Well, she heard from her CPA. She was trying to manage her expenses and all this information. But the reality is, the company she went with does not convert any of their policies. That's why it was less expensive.
Oh,
but
wow.
really less expensive. Let's talk about that. She gets into a medical situation that does not kill her. And she does live, because medicine continues to improve year over year over year. People don't die from heart attacks and strokes like they used to. They still do, but not to the amount that they do now, right? Medicine has become very good, and people who have those events continue to live. So let's say she lives just 21 years. She's not going to have a policy. She's not going to be able to take care of whoever because of $35.
Right, because she can't convert it.
Exactly. And to your point and our point of this conversation is that as a consumer, if you're watching this, as a consumer, please understand your situation changes. It's not always the same. And if you're working with an advisor that is not helping you understand the changes of your lifestyle that is going to occur, and making decisions today, again, to my point, know the exit strategy before you enter. If you're not making and doing that due diligence, you need to stop what you're doing right now and start having that due diligence conversation. Because the bottom line is that it's you as the consumer that accepts the consequences of whatever it is, good or bad. But you are accepting the consequences, because 100% of the time, it is your dollars. It is your money. It is your plan, no matter what. And so anyway, Lisa, I could go on for probably another hour, 2 hours. I know it would just be you and I talking, and no one else would be watching.
Right.
So we'll have to have that conversation, just you and I, and continue our geekiness, if you will. But to you, the viewers, I just want to say, for the viewers, Lisa, thank you so much for the time, for the expertise, for being so willing to share the knowledge that you've worked hard to gather. Sharing some of the experiences that you've had with some of your clients and your situations. And I think the viewers probably are sitting there looking at their own situation, thinking about how this may be of an option for them. And fantastic, the reason why this podcast exists. And I just want to say thank you very much to you, the viewer, for taking the time out to gather a little extra information, investing this time in yourself, because the reality is you're not investing it in us, it's in yourself. You're gathering the data, you're gathering the information, you're making yourself a better consumer by understanding this information. That's why I want to give this information out to you, why I bring unique situations like Lisa and life settlements to your computer, so you can get this information and bring up additional questions. Questions are fantastic. They lead you to an answer, or lead you to another question that eventually leads you to the answer that you're looking for. So once again, my name is Robert Wolf. I'm an asset coach and a tax strategist with Terra Firma Business and Financial Consultants. You can email me at rwolf, RWOLF, at terrafirmaconsultantsllc.com. That's T as in Tom, E-R-R-A, F as in Frank, I-R, M as in Mary, A, the word consultants, plural, LLC.com. Or look at the email and the phone number from the email that you got from here, if that was simpler. But any questions that you have, please reach out to me, and then I will we'll start that whole conversation and bring Lisa on board and try to see if we can be of service to you as a client and consumer and help you do your due diligence. So thanks so much. That is the end of this podcast. I greatly appreciate it, and hope you have a wonderful day. Enjoy.
Thank you.